Thursday, March 27th, 1980. Lock that date in your mind. That was Silver Thursday, the day the Hunt brothers tried to corner the market, pushing silver to its legendary peak of $50 before the government stepped in and crashed it down. For 45 years, that $50 number wasn't just a price. It was a tombstone. It was a ceiling that everyone said would never be broken again. Well, look at your screens right now, because history didn't just repeat itself, it just got obliterated. Silver hasn't just passed $50, it has completely shattered the $60 barrier. But here is the terrifying part, the part that should make the hair on the back of your neck stand up. In 1980, the price spike was caused by two greedy brothers manipulating the market. Today, this isn't manipulation. This is desperation. What you're witnessing at $62 is the global industrial machine realizing, all at once, that the vaults are empty. This is the industrial boom colliding headfirst with a supply deficit that has been ignored for decades. And in the next 15 minutes, I'm going to prove to you, with hard data and undeniable facts, why $62 isn't the top, it's the floor. You need to understand the mechanics of what just happened in the last few hours. This wasn't a speculative bubble from retail traders on Reddit. This volume came from commercial entities. We are talking about the whales of industry, electronics giants, solar manufacturers, and defense contractors. Why now? Because the physics of our modern world have cornered them. You see, for the last 10 years, we have been building a green economy based on electricity. Electric vehicles, 5G towers, massive solar farms, AI servers. All of these technologies share one non-negotiable requirement: silver. It is the single most conductive metal on the periodic table. You cannot cheat physics. If you want a solar panel to be efficient, you need silver paste. If you want an EV battery to manage heat and electricity, you need silver contacts. Here's the data point that the mainstream media missed. The solar industry has shifted technology. We moved from standard PERC cells to TOPCon and HJT cells. To you and me, that's just acronyms. To the silver market, it's a death sentence for supply. These new high-efficiency panels require anywhere from 50% to 80% more silver per unit than the old ones. Last year alone, the solar industry consumed nearly 200 million ounces of silver. That was almost 20% of the entire global supply. But with the new mandates coming out of China and India to triple renewable capacity by 2030, that consumption number is skyrocketing. The industry realized this morning that if they don't secure physical metal today at $62, they won't be able to build their products tomorrow at any price. But demand is only half the story. The real horror show is on the supply side, and this is where the global frenzy comes from. You cannot just print silver like you print US dollars. You have to dig it out of the ground, and the ground is getting stingy. The primary silver mines in Mexico, the world's biggest producer, and Peru are reporting falling ore grades. That means they have to dig up tons more dirt just to get the same amount of silver they got 5 years ago. Production is flatlining, and in some regions, it's actually dropping. And here is the kicker: it takes about 10 to 15 years to permit, build, and start a new mine. So even if the price goes to $100 today and mining companies go crazy trying to find more, that new silver won't hit the market until 2035. We have a 10-year gap where demand is vertical and supply is horizontal. That gap is what $62 looks like. Let's talk about the short squeeze, because this is where the banks get involved. For decades, the price of silver was set on the COMEX and the LBMA in London. It was a paper market. Banks would trade contracts representing silver that didn't exist, just to keep the volatility low. They sold silver they didn't have. Today, the bluff was called. As the price crossed $55 and then $60, those massive financial institutions holding short positions, betting the price would go down, got trapped. They are currently facing billions in losses. To stop the bleeding, they have to buy back their contracts. They have to buy silver to cover their bets. But who is selling? Nobody. The miners aren't selling because they know the price is going higher. The investors aren't selling because they've waited 45 years for this. So the banks are forced to bid the price up and up and up. This is a classic commercial short squeeze, and it is violent. We also have to look at the gold to silver ratio. This is the most reliable historical indicator we have. Geologically, for every 1 ounce of gold in the earth, there are roughly 17 ounces of silver. Historically, the price ratio has hovered around 15.1 or 21. But recently, it was sitting at an absurd 85. 1. That meant silver was mathematically nearly 5 times cheaper than it should be relative to gold. The market is a self-correcting mechanism. It doesn't tolerate imbalances forever. With gold sitting at record highs, silver had to catch up. At $60, we are finally seeing that rubber band snap back. But even at $62, if you apply the historical inflation data from 1980, using the CPI numbers from back then, not the watered-down numbers they use today, Silver should theoretically be trading closer to $150 or even $200 just to match the purchasing power it had in 1980. That is why I say 62 is cheap. In real terms, it is still undervalued. Now, consider the geopolitical angle, because money never moves in a vacuum. Look east. The Shanghai Gold Exchange in China has been trading silver at a premium over the New York and London prices for months. China has been draining physical stockpiles from the West. Why? Because China controls the global solar panel market and the EV battery market. They know that silver is a strategic metal. It's not just a precious metal anymore. It is a war metal. You need it for guidance systems and missiles. You need it for satellites. You need it for the entire digital infrastructure. China decided they would rather hold the physical metal than U.S. Treasury bonds. Today's price action confirms that pricing power has shifted. London doesn't set the price anymore. Shanghai and physical demand do. The vaults in London are reporting record low inventories. The registered category of silver, the stuff that is actually available for delivery, is bleeding out. Once that hits zero, price discovery becomes meaningless because there is no metal to buy. And don't ignore the psychological shift that just happened. For years, the average person chased crypto or tech stocks. Silver was boring. It was grandpa's investment. But $62 changes the psychology. It breaks the mental barrier. Now, the mainstream news outlets, CNBC, Bloomberg, BBC, they have to talk about it. And when they talk about it, the retail public wakes up. We haven't even seen the retail frenzy yet. Imagine when millions of people start trying to buy physical silver coins and bars, only to find out the local dealers are sold out. That is the frenzy part of the headline. When the public enters a market that is already cornered by industry, you get a parabolic move. We saw it in the 1970s, and we are seeing the early stages of it right now. But I want to ground this in reality. Is there a risk? Of course. High volatility brings corrections. We might see a pullback to $58 or $55 as traders take profits. But the trend is undeniable because the fundamental driver isn't speculation, it's consumption. Every time a Tesla rolls off the line, silver is consumed. Every time a solar farm is connected to the grid, silver is consumed. Unlike gold, which sits in a vault forever, silver gets used up. It goes into landfills. It is lost. We are burning through our above-ground stockpiles at a rate that is unsustainable. The deficit this year was projected to be 215 million ounces. That was before this boom. With this panic buying, the deficit could widen to numbers we have never seen before. So, what does this mean for the global economy? It signals inflation is entrenched. Silver is often the canary in the coal mine for currency devaluation. When the dollar loses purchasing power, hard assets rise. Breaking $62 is the market shouting that fiat currency is losing trust. But more importantly, it signals the commodity supercycle. We are moving from an era of financial assets, stocks and bonds, to an era of hard assets. Things you can touch, things you need. You can't print silver, you can't code it, and you can't artificially generate it with AI. This moment, right now, as we watch the ticker tape flash, $62.50, then $63. This is the transfer of wealth. It's a transfer from those who hold paper to those who hold value. The industrial giants know it. The central banks who have been quietly buying gold and silver know it. And now the market knows it. The chains that held silver down for 4 decades, the paper shorts, the manipulation, the skepticism, have been melted by the heat of industrial necessity. In conclusion, do not look at this as a one-day event. This is a structural break in the financial system. The silver barrier wasn't just a number, it was a dam holding back a flood of reality. That dam has burst. Whether you are an investor, a tech enthusiast, or just an observer, you need to pay attention. Because when a metal that is essential to the future of energy and technology breaks its all-time high, it tells us that the future is going to be much more expensive and much more resource-constrained than anyone planned for. The $62 silver era has begun, and if the data is right, the climb has only just started. Don't blink. The world just changed.